Hey everybody, Crypto Stu here again. Welcome back to the channel. In this video, we're going to be having a look at moving averages. So moving averages are another very common and popular type of indicator that traders use, and they can be used to help with your bias or trend identification. And they can also be used to help with entries and timing your trades. So generally speaking, there are two main types of moving average: a simple moving average and an exponential moving average. And the difference between those two is the simple, as the name suggests, is just a simple calculation averaging the price over X number of periods. The exponential moving average is weighted more heavily towards recent price action. So you're getting a bit more of a bias towards what's happened most recently with an exponential moving average, and it will therefore move a little bit quicker than a simple moving average. So what I've got on the chart here is a 200-day moving average. The red one is the exponential moving average, and the blue one is the simple moving average. And you can see here that it does move. It's not quite as smooth as the simple moving average. Now, in general, I prefer the exponential moving average, and I think most traders out there use the exponential because of its recency bias, if you like. So, a couple of things that we can use this for. This is a 200 period moving average. So it's essentially what that's saying is it's looking at the last 200 candles and their closing price, and it's calculating an average based on that. And as we've discussed, with a weighting towards the more recent price action. So what we can see here is that price at the moment on Bitcoin is above its 200-day moving average. And this 200-day moving average, this is something that's widely used across all asset classes. Big institutional traders will look at this, and it's a simple way to tell, is the market bullish or is it bearish? If price is above the 200-day moving average, then price is bullish because it's higher than it has been on average for the last 200 days. If it's below, it's bearish, etc. Now, obviously, it can spend a lot of time above the 200-day moving average and be moving down. But it's a good way to just get a very basic understanding of bullish versus bearish. And oftentimes, the 200 period moving average can act as an area of support or resistance. Now, it's also important to realize that the moving average is dependent on the time frame that you're looking at. So this 200 period moving average on a daily chart is looking at the last 200 days. If I was to look at a weekly chart, then the 200 period moving average is looking at the last 200 weeks. Likewise, on a 5-minute chart, it's going to be looking at the last 200 5-minute candles. So if we go back to the daily, this would be considered a slow moving average. What traders often do is add a fast or even two faster moving averages that can help them see quicker changes in trend, if you like. So what we can do here is add another moving average. So let's find exponential moving average. And I'm going to change this to 20 period moving average, and I'm going to make it blue just so that it's easy to differentiate between the 200 period moving average. So now we've got a 200-day moving average and a 20-day moving average. And as we can see, the 20-day moving average follows price much more closely and will change direction much more quickly than the slower moving average. So you could have a simple kind of strategy or system in place where your bias is if the 200 and the 20 or if the 20 period moving average is above the 200 period moving average, then you're bullish. And if it's below, as it crossed over here, then we turned to bearish. Now, obviously, in this situation, it quickly reversed and started moving up again. But again, you would get this cross of these moving averages again, so that it went bearish, but then it quickly changed to being bullish again. And then, as we can see, that trend then continued. So those are moving averages. They can be very useful. They can also be used to see when price has moved a considerable distance from the moving average. You could expect that in this type of situation, your momentum-based indicators are also going to be showing you that price is beginning to get a little bit overbought, because it's been a long time since it's been close to the moving average. So hope that was helpful. In the next video, what we'll do is kind of put all of what we've discussed together to start looking at a very simple beginner-friendly strategy that you could perhaps start experimenting with. See you in the next video.